Well, welcome everybody. Thank everyone to come here on this Monday night. This is Jerry Sanchez of the Multifamily Connection. This is the Carolina Multifamily Connection. And again, I started this back in December of 2020 as a means to connect both investors who are out of state and investors that are in state and looking to partner and focusing on the Carolina area. Tonight's our guest is Jared Frothinger from Lima One Capital, and a very timely discussion that we're going to go over on financing your multifamily deals. I'll let Jared introduce himself, but it's pretty wide open discussion. Drop questions in the chat. He'll also give you opportunities to raise your hand and join in. Well, thanks, Jared, for coming on.
Thank you for having me. Jump in and take it away.
Yes, sir.
Excellent. Perfect. Thank you all for allowing me to visit with you tonight. Jerry, thank you dearly for letting me on and in front of the investor group. You are my focus and you're who I look for all day long. So to have you all in one spot is a really good thing. So I appreciate that. A couple of things, kind of a super high level. We are corporately headquarters in Greenville, South Carolina, so certainly familiar with both the Carolina markets. In the last, 12 to 18 months, funded, I think, about 3 projects in Winston-Salem, a couple in Greenville, North Carolina. Charlotte's been a good market for us. Hickory, I heard out there, in Fayetteville, we have financed projects in all of those and probably just about everywhere there. Lima One's grown out of South Carolina or out of Greenville over the last 13 years. So I know that we've got some coverage in that market, know that market well, and that's usually a good thing from a lender perspective. Super high level on kind of what Lima One does. And then I was, depending on where anybody wanted to go, but I was hoping we could attack a little bit kind of how we look at a project, how we underwrite it, what's important to us from a lender perspective, loan structure, pricing, kind of anything and everything is on the table. My view of, I only do multifamily bridge loans, so I get involved in projects that usually have some type of upside in them or some reason that they don't want to take out kind of permanent debt day one. So that's all that I do. I don't do the perm stuff. I don't do a lot of different things, but multifamily bridge do day in and day out. So have really good knowledge there. Market's been turbulent for the last 9 months, 6 months, if you will. The last 3 days, I don't think we know the turbulence that's been created yet, but going to find out shortly, if you will. But at the end of the day, you're going to have real estate on at certain places that forever will be leased out to multifamily tenants. They need those places to live. It'll change how we finance stuff a little bit. I don't think it'll get crazy, but the world keeps changing. But at the end of the day, multifamily buildings have always been a safe place to put money. Value add's been a place to make outsized kind of returns, and I think that will continue into the future. From a Lima One Capital perspective, we do kind of 4 different things. One is kind of multifamily bridge that we're going to spend just about all this time talking about. But to give everybody kind of a sense, for the last 13 years, Lima One's been lending. We started as fix and flip lenders, so I heard some on the phone kind of talk about fix and flip. We've grown that into single family rental portfolios. We've grown that into Airbnb long-term rentals. We've grown that into ground up single family. So from a Lima One perspective, you'd think of kind of 2 things. Anything that's investor single family, we can work on. And for most of this call, we're going to focus on just the multifamily bridge. Within Lima, that's about 90% of what I do. 80 to 90% is just multifamily bridge. So that's really my specialty. As a company, we're probably more balanced than that across all the different areas. But I love where we came from a Lima One perspective, because we're used to working on kind of smaller projects. And what that does from a multifamily bridge perspective is we're used to making small draws. We're used to being very transparent and reactive to our clients. The bigger players that you work with, they don't want to talk to you unless you're advancing $50,000 for a draw for work and this, that, the other, and they can make it really, really complicated. We come from the other side of that. We're used to advancing $2,750 on Monday morning, so you got enough dollars for payroll on Friday on a fix and flip house. So just a different place to come from, but I think it's an advantage. Multifamily bridge at a super high level kind of structure that we typically talk about on our multifamily projects. Again, we get involved in usually acquisition business, but we're doing some other things that I'll touch on in a minute as well. So usually somebody's going to buy value add type projects. They see that if they put some dollars into the property that they can lift rents, or maybe buying it from a long-time buyer who hasn't invested in the property, hasn't moved up rents, etc. And by doing that, you certainly can get some outside returns, outside of normal returns, if you will. Typical kind of structure on these projects is somewhere between 75 to 80% loan to cost. Today, that's probably closer to 75 on average, but each project's a little bit different. It has to do with the cash flow and the valuation at exit. So kind of 75% loan to cost between purchase and rehab is normal. Typical term is usually 24 months. We do allow 36 months, but I'm not cheap from an interest rate perspective. So typically folks want to get in, fix a property, and get me out. Interest rate that we have today is somewhere between about 9.5 and 10.5 fixed rates. We're a fixed rate lender. There's a lot of lenders that are variable rate today, just different, not one's better, one's worse. Certainly, if we go back about 2 years, I think everybody would take fixed, but we didn't know it at the time. What you take today, I can't tell you what the best is going to be for the future, but you can predict what our payments are going to be because we're fixed rates. Typically, 24 months, as just pointed out, interest-only payments, non-recourse debt. So there's a lot of lenders that require recourse. Our loans are not. As long as you've completed at least one multifamily purchase, 5 units or more in the past, we have interest in financing. That's kind of our experience box checked off as one, ownership of any 1 5-unit property in the past. Once you've checked that off, we've got interest in financing it. If you get to a much bigger project, 100 units or more, we're probably going to ask more questions around the experience, but kind of inside of that, we typically don't, honestly. Typically, a 1% origination fee is the cost of doing a loan, and there's a 1% exit fee, or you can do a 1.5% origination fee and no exit fee. So kind of the costs involved in it. And the only other question that I typically get is kind of prepayment penalty on our loans, and that's typically a 12-month interest or 12-month minimum interest period. So if you do 24 months, we need to make at least 12 months of interest. If you pay me off in month 10, we'll collect 2 months of interest at that point. If you pay me off in month 13, 14, or 15, you just owe the interest that's due, if you will. Last thing I'd like to point out is we only charge interest on advance funds. So typically in these projects, you're going to do some type of renovation at the unit or building level. We'll put facilities in place, so you got those dollars available once that work's been completed, but you're not charged any interest on it until that work has been completed and advanced. I think I'll pause there rather than continue to throw stuff out. And Jerry or others, maybe some questions. And if not, I can go into kind of underwriting if you'd like.
Yeah, so I guess, kind of to unpack, that, bridge financing is essentially short-term option that investors will have in their tool set, right? To bridge or gap between their short-term cash needs and their long-term horizons. How about, kind of giving it from the perspective of the investor? When does the investor choose to make this decision and to go with bridge, versus traditional? And is there typically also because they have to reach certain parameters if they're going to go for, say, a Fannie or a Freddie, Matt? Well,
yep. So typically I'm going to underwrite into kind of Freddie or Fannie agency type exits. So I'm really underwriting to what their loans are, because I know if you can get the building to that level, I'll get paid off, and that's what a bridge lender wants. So I want to put together a loan today, but I want to make sure I can exit it within a reasonable amount of time, a couple of year period, if you will. Kind of back to your question on kind of why would you use bridge? Awesome question. I probably should have started there. So thank you for bringing me back to it. This is typically that there's something going on at the property that either long-term financing is not available. We'll talk about that in just a second. Or secondly, that you don't want to take it out because you don't want to leave kind of hidden or trapped equity in a project. So typically, if you take out a long-term loan, I'm taking it out today and I'm going to take it out for the next 10 years, if you will, is typical term. It's usually got a prepayment penalty of yield maintenance on it, which means when you pay it off, you got to figure out what the interest rates are today. You're going to subtract it and you're going to pay a whole bunch of money for a prepayment penalty. So people that come to me for two reasons. One, they don't want to lock it in for 10-year term, might be the reason that, hey, I'm going to invest in this property. I'm going to put dollars in the unit. I'm going to take my NOI from, pick it, $50,000 up to $55,000. And I know that 5% increase in, or 10% increase in NOI is going to make my property kind of 10% more valuable. So what they can do is they can buy it with bridge debt and improve the property. And in fact, if they can get the valuation to pop to that level, then they can get back either all or some of their equity that they originally put into the property. So all of a sudden you could own the property on really long-term debt, but you can't lock it. You can't lock the loan up front because then you're locked into it for a 10-year period of time. Jerry, does that help? And if not, I'm sure there's some folks on the phone that have maybe had some bridge debt in the past and could speak to it even more clearly.
Yeah, that's a good point. That's good. I think if anyone that has used bridge want to jump on and maybe give an example of when they went to bridge as an option.
Nobody's used bridge.
All right. So here's one thing that I thought that you said also that was very important because right now variable or floating rate is like, it's a dirty word, right? But not all bridge loans, they can basically be structured as both floating rate or fixed rate. I'm assuming that would have probably right now people are leaning towards fixed, but traditionally, what's the mix between floating rate and fixed rate loans?
Yeah, there's really very few lenders that have fixed rate loans on the bridge side because most of them will use capital markets to bonds or different things, and they take the interest rate risk out of it, if you will, from the lender side. We're on the other side of it, that we're fixed rate. We're historically probably, 15% of the market plus or minus. Today, that might be 40% of the market. We're actually cheaper than the variable rates once they put in the interest rate caps, which they typically make you buy so the rates don't go over a certain amount. So we're doing more and more today. Flip side of it, it really should have been the opposite of that, right? 2 years ago, everybody should have done fixed rates, and today, maybe it's variable rate, maybe it's fixed. I'm not sure what 2 years from now interest rate environment is going to be.
So can I stop you there with, can you explain what is an interest rate cap?
Yes. First, on the answer, Tiffany asked a question about do we offer extensions. That answer is yes. There's typically 2 one-year extensions available on any of our bridge loans. So starting terms, 24 months. If you don't complete the project, you have 2 one-year extensions. There's usually a fee to those, and it's usually a 1% fee to execute on those. That's probably pretty standard in the interest rate environment. Jerry, I lost your question. It was super important, but bring me back to it and I'll execute.
I guess explain what an interest rate cap is.
Yep, perfect. Sorry, thank you. So interest rate cap, if you have a variable rate loan, what the lenders are going to be, it isn't what we do, but what lenders will be concerned about is if rates go up so far that it's going to put your project in trouble, because ultimately every time interest rates go up just a little bit, it costs you more money on a monthly basis. So a variable rate lender will come out and they'll say, go to the capital markets and get a 1% interest rate cap. So if you're going to lock money today at 9%, a 1% interest rate cap would say it'll never go over 10%, or somebody else will make that extra payment. So you as the client will never pay more than 10% on that loan. So it's still variable rate that it'll go up, but once it hits 10%, you won't pay more than 10%. That is called an interest rate cap. Historically, they haven't been super expensive. Today, they're really, really expensive, and it's got to do with the market's just not quite sure what future rates are going to look like. So when it becomes less predictable, that risk costs you more money. So it costs you a lot more to lock in.
Can I ask a question, Jerry?
Yes, ma'am.
Is it my option whether or not I want to get a cap lock, a rate lock, or does the lender dictate that I have to do that, or both?
Yeah, so again, I'm only fixed rates. Every lender may be slightly different, but just about everybody is requiring them today. So there may be some flexibility, Teresa, that you've got in what interest rate cap can I do. So I may tell you that I want 1%. You say 2% costs me a whole lot less, and we negotiate between the two to kind of keep that premium down. but almost think of it like an insurance policy. If it goes over a certain
Right.
level, they make the payments beyond that.
Got it.
Yep.
Are you able to shop? Is there an open market for shopping for interest rate caps?
Yeah, it is.
If you don't like the first quote you got, can you shop it to somebody else?
Yeah, you can. It's a pretty, I'm not sure. Again, we don't do that, so I'm not in that market on a daily basis, but there's a couple of big players, and I think they all price about the same because I think it's truly a capital market execution, if you will. I don't know that there's a premium markup there, but again, I'm not the expert there. Chatham's seems to do the vast majority of it. You see the derivative guys out there once in a while, and they're all involved in that space, but outside of my scope of knowledge.
Excellent.
I had a question. How's it going?
Good.
I'm in a JV that's really like a syndication, but we're in a bridge product. I don't know who it's with. I should know. But they are limiting. It sounds like they're limiting our draws, and like we're limited on our turns and value add, like turning the properties, because of our debt service coverage ratio or maybe our loan to cost. Can you talk about like what that looks like? Do you limit the draws that you'll give or withhold funding? Like, how do you evaluate that the cost is tracking?
Yep. Great question. I don't think that's probably our loan that you're working with. We don't have any covenants in our loan it's usually tied to occupancy level or NOI level or something along the way. So if you achieve this, we'll give you that is typically how some lenders will handle that. That actually brings me to one of the places we're doing more business today is called bridge to bridge financing. And that's ultimately if you have a bridge loan and your lender's either matured or I'm sorry, if the loan's matured or the lender's not working with you, that's kind of an exit for you. There's a lot of lenders that don't do that. We do. Back to kind of your question on how do we handle it. So how we handle it is upfront, we're underwriting the project. I'm going to send you kind of a CapEx construction budget and say, all right, Tiffany, tell me about the project that you're working on. How much do you intend to put at a unit level? Are you buying stoves? Are you putting in carpet? What are you doing? And then we come up with a property budget, if you will. So say that property budget's $500,000, unit levels, $15,000 to turn a unit. I made those numbers up, but they probably aren't too far off on some projects. So that CapEx budget we do up front is really what we use on the draws on the back. We don't have any covenants that say that you got to hit this or that in order to get those dollars. We simply say that, again, when you turn that unit, your stove's worth $2,000, your carpet's worth $3,500 or whatever numbers we've agreed on that CapEx budget before we close. Tiffany, does that give you enough to be dangerous or any follow-up questions?
No, that helps. That helps a lot. I have to just take it to my team that's managing it.
So before you jump ahead, because everybody has different experiences and different, I guess roles that they may look at in the multifamily team. You hear a lot about loan to cost, LTV. Can you go over, maybe kind of an easy, example or explanation of what loan to cost is?
Yep. So when we look at loan to cost, we're simply looking at purchase price of the property, and then secondly, what is the rehab that's going in it. So that's really all that we look at when we say loan to cost. There may be more that goes into that, closing fees and chasing fees and a variety of other things. But when we as the lender at Lima One look at it, we look at loan to cost at purchase price plus rehab budget. I think where you're going a little bit is kind of how do you underwrite that? So when I talked earlier that we'll do kind of 75 to 80% loan to cost. So truly add your purchase price and your rehab up, and we'll do 75 to 80% of those two numbers. We're looking for you and your other capital partners to come to the table with that, 20 to 25% equity. Heard a few of you on the phone, if not all of you, talk about raising it through partners and syndicated equity and a variety of things. We can handle all that. It's very common in our space, so good there. And then I'm going to underwrite. So my underwriting really looks at two major things. I'm looking at exit valuation. I'm going to look at exit cash flow. So I'm going to look at that kind of 2 years into the future. And what I'm underwriting to is can I get paid off by an agency lender in the future? That answer is yes, if I can stay under 70% of LTV at exit. So you may be going in at 80% LTC, but because you've increased the NOI of the property, it's worth more, as long as it can stay under, again, 70% exit LTV. And then the cash flow is really the constraining factor on most projects today. The lenders will look at that as a DSCR, which is really saying how much money is left after from your revenues is left after you make all your payments and expenses. And that ranges from about 120 to 140%, depending on the market. That gets a little bit more complicated, but I can sure work anybody through that one-on-one afterwards if you'd like.
Excellent. Anybody have any other specific questions? Okay, good. So yeah, I guess let's go a little bit about the underwriting. Some of what you look for is the team, or like what are the type of property, how long does it take to close a loan? Some of these things to for the investor to learn about.
Yep, fantastic. So there's a number of different kind of inputs, is what I call them, that I look at when looking at a property, and I'm simply taking those inputs and running a model with it, if you will. And that's everything from the address, which is going to drive what market size it's in. The very large markets, if I'm going to do something in New York City or Dallas, I can handle a much smaller cash flow coverage in those markets than if we're in Fayetteville or Greenville, South Carolina, et cetera. Those are going to be a wider cash flow need, a little bit more risk due to the rural nature, if you will. Then other things that we're going to look for in kind of those inputs, if you will, looking for experience. I touched on that earlier. So has the sponsor bought at least one 5-unit property in the past? If that answer is yes, then we can lend to them. Again, if we get a much larger loan over $5 million, over 100 units, I'm probably going to want to make sure that you have had a few steps before jumping from one 5-unit to that project. But in general, that's kind of what it looks like. Looking for the purchase price. Looking for the closing date. You'd asked earlier, Jerry, on kind of closing time frame. Typically about 28 days from the time we agree on a term sheet to the closing of the loan. We can rush reports, get the appraisal, environmental reports, et cetera, quicker. You can typically rush into about a 21-day close where needed. Everybody's always stressed in those situations, so like to avoid them where possible, but that's the business I live in. So if you've got something that's got to move quick, we can handle it. And kind of market standards probably closer to about 45 days. So as you're looking at a project, you need to really pick your lender and probably have 40-ish days for the lender to execute, if you will. Rehab amount, we talked about that earlier. Again, I'm going to use that on the draws. I want to know that up front. How much money are you going to stick in the property? Where's it going? What's it look like? At the sponsor level, in addition to the kind of 5 units or more that you have, also looking for your net worth. Net worth, I'm typically looking for 1 times loan amount. So however much money that you're looking to lend from us, I want to make sure you've got at least that net worth. There's not a whole lot of kind of checks and balances on that, but it's important that we understand that you're buying something within your range. That's a pretty normal for most all lenders out there, 1-to-1. And then FICO score, usually 680 plus is really what we work for in that. We might reach under that slightly, but pretty good credit is what's required really on the multifamily side for us, and I think probably most of my competitors. And then probably one of the places that you spend the most amount of time is really your pro forma. So I'm simply taking 2 numbers out of your pro forma. I'm taking out that stabilized value. So I want to make sure we're exiting on under 70% loan to value, as we talked earlier. And I'm looking at that stabilized NOI. 2 years into it, what's the NOI at the property after you've made the improvements? And that's helping me underwrite that DSCR. There's a lot that go into both of those numbers, and that's going to range everything from kind of what's the rents in the property today to what's the rents in the future, how much are you putting in there, how much are your expenses changing, et cetera. So there's a lot of work that goes in that pro forma. At the end of the day, I'm really looking to you as the expert on that property. You tell me what you believe that stabilized value and stabilized NOI is. We're going to ask an appraiser to go out and give their kind of professional opinion on what they think it's worth, and given that it's pretty close to yours, then our loan usually works. Today, we're probably seeing more and more rent increases. So there's some opportunities that kind of value and NOI increases even beyond historical numbers. But right now, cap rates are widening out just a little bit, which is really the NOI times the cap rate or number gives you valuation. Those cap rates are widening a little bit due to the environment that we're in, and that's going to put downward pressure on value. So we are seeing that once in a while today. That was a lot of stuff. Break it down and unpack it as you see fit.
Yeah, I think I see Ahmed dropped a note in there about what to look for in a guarantor's liquidity, what ratios. I think we touched some of that. Question I have is that, a lot of us here syndicate. So when you're bringing when a team is coming to you, is it one person that's signing on the loan, or to meet that net worth criteria? Is it multiple people that can sign on the loan? How does that work?
Yep. So typically for us, required signers, I'm going to start on the opposite side of that. So required signers are who's really running the property on a daily basis. And then typically anybody that's got 20% or more ownership in the property is who we have sign. Keep in mind, again, I'm a non-recourse lender, which simply means if things go to heck, you got to throw us the keys back to the property, but we're not going to go after your car and your house and other stuff. It's all about the property. Now, back to kind of who has to sign and the syndications, et cetera. The short answer to that is anything that's under 20% really doesn't need the net worth or liquidity to make our loan work. We don't need signing from them. So very common for us to work with limited equity partners and again, a variety of different pieces. But if you're not running the property on a daily basis, I don't need the net worth, I don't need the credit, and they aren't owning at least 20% of it in an individual name, then there's probably no need for them to sign.
Okay. Can I ask a question? I'm sorry.
Mm-hmm.
Good stuff. Thank you so much. What Jerry was saying, a lot of us do syndication. I personally would like to sponsor my own loan one day, but obviously I'm not there. I got a couple of apartments. I'm with syndication right now with 3-4 units, but eventually I want to meet that requirement where I can actually get a non-recourse loan, right, under my own name, so I can actually build my net worth better, So you mentioned something along the line that has to be 1-to-1 liquidity. Is that what you said? So the amount of loan has to, or net worth, you said, right?
Yes. Yep.
Okay. So as we are partners in these syndication deals, we acquire a little bit more of liquidity, net worth, basically gain more and more every time you syndicate with somebody, even as a limited partnership. You take that into account, right?
Yeah. So anybody that's a signer, so if your limited partners aren't signing, I'm not going to count their net worth. But everybody that is a signer, I'm going to add up all the net worth, all the experience, and all the liquidity together.
Well, it just means like if I want to do my own deals in the future, I just have to do the personal financial statement, figure out that number, right?
Yep.
And based on that baseline, I can get the amount loan, right?
Right. Exactly.
Okay.
Yep. And again, keep in mind, it's not liquidity. So it's not just their checking account balance, but it's
net worth.
It's the net worth. Yep.
Beautiful. Thank you.
Hey, Jared, I got a question for you. If I can maybe switch gears to new construction, new development.
Sure.
So if I can just throw out there, working on a deal now. It's in Lancaster. We're currently going through the entitlement process. So we're expecting June, July to get the project fully permitted. The construction cost is in a range from 27 million to around 31 million. The valuation of that project potentially could run somewhere in the range from 38 to maybe 41 million. And we're just trying to see our options as far as financing. It's a 200 unit, typical bread and butter stuff you see down here in the Carolinas, garden level apartment style in a nice property about 35 minutes south of Charlotte.
Gotcha. Yeah, I'm not much help to kind of structure what those terms should look like. We do some ground up development on the single family and very small multifamily. So my requirements are 9 units or less, $5 million or less on the loan size. You're at 27 to 31. You're significantly larger than what I can handle. So I'm no help to lining you out there at all. Sorry.
Thank you anyway. Yeah, thanks anyways.
Yep.
Does that include like prefab manufactured homes or mobile homes, or
Yeah, so
you guys do anything like that?
great question. The manufactured homes, apartment buildings, et cetera, if you back up 5 years ago and before, anything that said manufactured or pre-construction or any of that
Right.
is just kind of off the table.
Right.
It's still, I would call it difficult today, and it's difficult on the construction side of it because they build it off site and our collateral is on this lot. So all of a sudden I've started advancing funds and the lot's still bare dirt. And if things go to heck, I don't have the walls, I don't have anything. So that's how we think. I don't want to say how everybody thinks. Now, there's been some very large changes in our thought process around that. Our head of construction made this statement. It's sat with me well. He said, how many of you have bought a new car and had them build it in your garage or in your driveway? And his messaging is pretty clear that they can be experts offsite at building something, bring it in and put it up. So we're making huge progress in that area when we didn't make progress for the last 200 years, if you will. So I think it's coming. I think case by case, we can handle a few of those, if you will.
Same thing with shipping containers, homes.
Yeah, I had one of those I looked at and we didn't do it. I don't know if it was for that reason or not, but I think that's going to be difficult to get to fit in the box. That's probably the wrong word to use there.
I came late into the call. Sorry about that. But
Okay.
what state do you cover? Do you cover Puerto Rico?
We don't cover Puerto Rico. 47 states, North Dakota, South Dakota, and Alaska are out. Maybe like Vermont, but everything else we can handle.
What about the moon? Me and Jerry want to buy properties on the moon.
I am with you. We got to go visit
on
it
the
first.
light side of the moon, not the dark side of the moon.
I like it. Keep us out of trouble on the dark side of the moon.
Excellent. All right, Jared. So I think it's time. Let's talk a little bit about current situation. Obviously, most people here are probably aware of Silicon Valley Bank, Signature, who definitely dealt with a lot of real estate operating accounts. Where do you see the current environment in terms of those of us that are working on current projects and going out looking for lending?
Yep. I'm not an expert here. I'm an amateur, so I'm not sure that anything I give you here is more than just being around it for an awful long time. No matter what, kind of where I started at the beginning of the call, the multifamily building on the corner of 3rd and 5th is going to be a great location. People are going to need to live there, etc. So that will never change, right? But it can get bumpy between here and there on who finances and what leverage point, what interest rates, and all those different kind of inputs, if you will. It surprised me Friday as some things were melting down and kind of over the weekend, and I was tracking the situation. I worked in commercial banking for about 20 years before I worked in private lending over the last 10. And there was very little kind of news coverage, in my opinion, on the front page of Yahoo or whatever that you're looking at to kind of understand what's going on. Now, if you dug into the finance page, there's a lot more articles on what's going on. I guess that's just because I'm the nerd and wanted the details and dig into it from that perspective. I thought the Fed did a good job of standing up behind and making sure that all of the deposits were insured, or I shouldn't say insured, but not going to be lost. I think that was important because I think that could have created a lot of other dominoes. There's some mismatching on the bank's balance sheets. I think it's going to affect some others. The Fed tried to use that new facility that they set up for others to use. So it's my belief is the government doesn't want a whole lot of these to come crashing down because it will be a problem. Most of the articles out there, again, I'm not the expert, but they're starting to predict that with these challenges that came over the last couple of days, the Fed's going to have to slow down or maybe even pause the rate increases over the course of time. You can see that on the 2-year swap rates is really what the majority of the market kind of lends off of. And that thing's run up about 70 points in the last 6 weeks. And in the last day and a half, it's dropped all of that and then some. So there's a major kind of shift in what the market's predicting future interest rate moves will be. So I think that goes in line with some of those articles that the Fed's going to have to slow down. They're not saying that. I think it's tough for them to say, because we're bowing down to the banking industry, we can't do this or that, the other. all of that said, what I believe is, again, I think it's going to be rocky a little bit. Banks have played a large role in real estate to some degree. They have taken everybody's checking account, paid them next to nothing on it, and kind of lent it out to you at 6-7%, and that was kind of their spread. What I think is going to happen is I think all the interest rates on kind of all accounts are going to go up a little bit, so they're going to pay more for deposits. They're going to have to figure out how to pass that on to their clients, which is going to be higher rates. And I'm hoping they're going to be more in line with kind of where we're at. I also believe that the regulators will probably scrutinize a little bit further. And again, banks typically like cash flowing assets and different things like that. As soon as they become these value add that, hey, it doesn't cash flow today, but I'm going to invest in it, it's going to be worth more tomorrow, causes trouble for them, for their regulators, et cetera. So I think that's probably going to give their space back to us kind of bridge lenders, if you will, where it has been historically. That's me guessing, but everybody on the phone calls probably got way more accurate kind of feedback than I. So I don't know if anybody else wants to share or any questions. We can go from there.
I think we're all trying to sort it out. That's for sure.
There's a lot to back.
In just, I guess in terms of going out right now and someone who's applying for a loan, are you anticipating a little bit of tightness in the kind of, you're looking for more experience right now, or are you looking for, a little, obviously try to mitigate your risk?
Yeah, so here's what I would say, and I got to use kind of prior to Thursday of last week, because I'm not sure what happened from Thursday to today is out at 6 o'clock on Monday night after it kind of rolled out yesterday. So it'll take a little bit of time to hit there. From my business, from our business at Lima One, we got a little bit more conservative about last September. We dropped kind of our maximum loan sizes. We pulled back leverage on some of our single family projects. Interestingly enough, on Friday morning, we started expanding. We used to do $15 million loans. We went down to $9 million loans. On Friday, before all of this kind of hit the news, we increased back up to about 12.5 and opened to $15 million loans again on the multifamily side. We increased our loan to value on our fix and flip loans it went from 85 to 80, and now we're going back to 85%. So we're getting more aggressive. So as of last Friday, we wanted more, and we were kind of getting back to what happened before September. So that tells me we were heading the right direction. Again, over the weekend, I don't think you're going to be able to see how lenders are going to handle this in the very short term, other than you can see interest rates are actually coming in. So I think that's a positive to those that want to get transactions done today. Do I personally think that things will tighten up in the market in terms of underwriting? I do. I think it'll take a few weeks to a few months probably to see that, to get that rolled out, et cetera, is my 2 cents.
Awesome. Anybody else have any other questions to throw at?
The lender side, one other thing, not quite on the agenda here, but I'm going to throw it out there anyway. I think it's always very healthy to have multiple lenders, I call it, in the barn. Somebody that you've worked with, even if you really, really like this person or that institution, things change. That bank can change, that person can leave, anything can go on. I'm a big advocate of having, I call it, multiple horses in the barn, that have 2 or 3 people that you work with over the course of time, that when you get in a jam, you can pick up the phone and call the next one, and somebody will kind of help you or bail you out. So I think it's important, if you've got a relationship somewhere, keep that relationship intact. You never want to burn bridges, especially in today's world, it feels like, but have other lenders that you reach out to. I would tell you, if I look at today compared to a year ago, there's probably 40% or less lenders than there were even a year ago in my space specifically. And I think you're going to see some of that on the bank side. I don't want to say they go away, but I think they're going to change where their focus is and may or may not have interest in certain areas to lend. And that's where, again, having multiple outlets for loans won't hurt you.
So to piggyback on that, how early do you work with clients? Like, somebody has a property, before they even put out a PSA, will you, kind of take some high level underwriting and give some, feedback?
Yep. So yes is the answer to that. I've got a variety of folks will approach me at different times on what projects that they're working with or have under contract, et cetera. I'd tell you my smaller, less experienced folks probably get me involved earlier in the process, which is super smart. Because then we can kind of steer them through, here's how we're looking at, here's what we're thinking, and maybe help guide some of purchase price or other structure that they're trying to put forth. Now, my more experienced folks that probably have 2 or 3 lenders in their barn, if you will, they know how this should be financed. They know that somebody out there will take it. They probably don't get me involved until it's under contract and say, Jared, I'm sending this out to you and 3 others and need quotes by Friday, and we're going to pick a lender by Tuesday. But that's more institutional level, if you will.
Got it.
I just sent
Steve,
to everybody my inputs on the chat list. So really, again, nothing special here, but that's really what I need to model a project. So if anybody's interested, that's what it takes to do the modeling. Now there's work that goes into, especially that pro forma at the end of it. How do I get to stabilized value and stabilized NOI? So it takes some stuff to get there. But if you send me those inputs, I can tell you what our loan looks like.
Okay. How about, not all products are created equal, but, talk a little bit about, we talked about what is bridge, but do you have, I guess different types? Do you deal with DSCR loans or, things like that, like just, get an understanding?
Yeah, so we're really a non-recourse bridge lender. So what that tells you, to unpack that a little bit, is non-recourse. So you're not guaranteeing your other assets. So isn't your car and your house also tied up in it? It's just this project multifamily building that you're buying. Secondly, it's a bridge loan, so it's not a permanent loan. A permanent loan is usually one that's cash flown today. You're going to put it away for 10 years. I don't do that lending, but that's what that loan is, really a long-term loan, if you will. Now, there's all kinds of different loans out there. You can go to a bank loan, give your recourse. It's probably a lower rate at a lower leverage point. Next side of it, you can probably go to a hard money lender. They're probably double-digit plus returns. But they may give you a very high advance rate, if not 100% financing. So I think that's 2 different worlds, if you will. Jerry, was there something more specifically there?
No, I think that's a good kind of answer what I'm looking for. What minimum loan amount do you grant?
Yeah, so typically I work in the kind of $1 to $10 million loan size. By policy, we'll actually go down to $500,000. Under $1 million, usually got to be pretty straightforward, pretty easy. It takes as much work, honestly, to do a $10 million loan as it does to take a $500,000 loan. But a small town kid from the Midwest, and I love to see people get started and do well. So happy to help on the first few projects as well.
Okay. Excellent.
And then I had a question. Is there obviously you're doing bridge debt, which just means there's some level of value add to it. Is there a property that would be too bad to do? Like it's just beyond your requirements?
Yep, great question. So some things we don't do: completely vacant buildings, I don't handle today. Conversion projects, I don't handle today. So somebody's taking a hotel and wants their motel and change it into an apartment building, we don't handle that. And that's probably the larger ground ups we talked about before. And again, you can kind of go through each piece of it that if they don't have the credit, they don't have this, that, the other, all of those would be kickouts. Something that sometimes surprises folks is we don't really care what the cash flow is day one, as long as it isn't vacant. So I know that all the pieces that are property, the HVAC, everything works within the property as long as it isn't vacant. I don't really care if it's 20% occupied or 70% occupied or 95% occupied. As long as I understand I understand the market, we can get comfortable on the right project, even with very high vacancy numbers.
Great. Got a couple of minutes left. I like to, cut it off at 8:30, and then we kind of break out. You, by the way, Jared, don't have to hang around for that. One thing I wanted to ask, there's a few of us here who, as we're trying to find properties, which is the hardest, part, do direct to seller or kind of look at own, take down lists and look at that. Is there any insight in terms of potentially finding, loans that may be potentially or sponsor owners that are heading into some issues, whether it's they took some bridge and now it's coming up, and how can we identify that?
I think great question. A lot of people are searching for that a little bit, which they always are because they're trying to figure out how to get in front of it. What I'd say a little bit is even the investment sales folks are probably a little bit hungry today, and that's a good thing for each and every one of you. A year ago, there was a tremendous amount of people bidding on every project. I think they probably got bid up further than they should. Today, that investment sales guy still got the same car payment, still got the same house payment. He's got to sell that property. So he's looking for properties and he's looking for buyers. So I would encourage you to get to know some of whatever market you're working in, the investment sales, and be very clear with them. I'm looking for a property between this purchase price and this purchase price, this many units, whatever's kind of important to you. If you line them out on what you're looking for, if they don't have it and they got enough time, which they do today, they'll probably knock on some doors and look. The lenders really don't have much on the charge-off books yet. Knock on wood. Will that change in the future? I think so. Should have probably changed years ago, and it still really hasn't. But because all the rents have increased in these buildings, I think people bought stuff 3, 4, 5 years ago, and there's pretty good equity in front of them. So I don't expect them to get hurt, but people got to trade. Another thing that's kind of out there is, and all of you that are working in syndications know this, that there's usually a sundown time in your syndication. So the property's got to be sold at year 5 or year 7 or whatever. Some flexibility, more flexibility actually in today's syndications than there were 5 years ago or 7 years ago. So some of those may come up and they're going to have to sell, and kind of whatever the going market is what they're going to get. I think those will be good opportunities. And then once you've closed with a project with a investment salesperson, I would stay in front of them as well. Like, this is what I'm looking for. I want another one just like it, or a little bit bigger, or a little bit however different. You'll train them quickly. And again, they're trying to get a paycheck. So what they're going to do is go out and find something for somebody that just closed with that looks something like that so they can close again.
Yeah. Yep. Yeah. Becomes the chicken and egg conversation, but 100%. Yeah, absolutely. Well, Jared, I appreciate you coming on. I guess before we sign off, just any last questions for any of the audience out there? And also you may have done this already, but put your information in the chat.
Perfect. I will have it there in 1 second. I wish everybody the best of luck. Reach out to me if anything comes up. Make sure you don't spell my email address wrong. That won't help. And look forward to helping anybody we can at any point in the future.